So again, thank you everyone for joining us today. Whether you're joining us from the GFI India network or whether you're joining us from the BioAngels network, we really appreciate you taking out the time to coming on board today. I just want to start off by thanking all of our partners. So Startup India, the Federation of Indian Asian Biotech Association, Indian Angel Network, AIC Nalanda Association of Biotechnology-led Enterprises, and IKP Knowledge Park, who collaborated with us to make this webinar possible. And all of our speakers here you see who have agreed to come on board and share their experiences and insights with all of us. So to start off, for those who are not yet familiar with our organization, the Good Food Institute India is a part of a network of global nonprofit agencies working on the business, scientific, policy landscape to diversify protein sources for a more healthy, sustainable, and just food system. We focus on what we call smart protein, which is globally known as alternative protein, which is a rapidly growing sector on developing viable alternatives to animal-derived meat, eggs, dairy, with vastly better implications for food security, public health, and planetary health. When we say smart protein, we're referring to three categories of food: plant-based, cultivated, and fermentation-derived meat, eggs, and dairy, and seafood. So I hope that gives you a bit of an introduction of what we do at GFI India. And if there's anyone who wants to reach out to us to understand more, I would be happy to drop my email in the chat box for you to take a conversation further. I'll let Sandro quickly introduce BioAngels and the extraordinary work they do before starting today's session.
Thanks, Purvansha. Welcome all. Good evening. Welcome to the special BioAngel fireside chat on the art of pitching, navigating the funding winter. My name is Sandro Stephen. I am the Vice President at Indian Angel Network. So I will be the host for the evening today, where we're going to focus on angel investment as a concept and the pitching of investment to investors in this specific funding window. BioAngel, just to give you a background about BioAngel is one of the platform in partnership with ION. This is a strategic partnership between ION and BioRack. It is India's first sector-focused angel investor network group, which is focused on biotech, health tech, medtech, pharma, clean tech, and agri-tech. The focus is to bring in money, mentoring, and market access, which is the main core strength of Indian Angel Network, which is also backing and help the ecosystem grow in the space.
Thank you so much for giving that quick introduction. So in partnership, like Sandro mentioned, with BioAngels, we've launched this three-part knowledge series called Financing the Future, through which we're looking to increase investor interest and engagement in the smart protein sector and support founders working in this space to get access to the right kind of capital by bringing in investors and other experts who can share their experiences and stories similar to the speakers that we have on board today. We hope that this series can serve as a helpful guide for anyone who's looking to either invest or just understand the investment landscape of such nascent yet promising sectors. For anyone who is not able to attend the first two sessions of our series, I'll drop the link in the chat box below to view the recording of both the webinars, which are now online on our YouTube channel. And this brings us back to today's session, Art of Pitching. Not to take any more time, I'll hand it back over to our moderator. Thank you again for coming in to steward this conversation today.
Thanks, Purvansha. I hope I'm right this time.
There's no end. It's just Purvasha.
Purvasha.
Thank you.
Right. So, welcome, folks. Welcome to the pitch session. Welcome to the session here. In today's fireside chat, I'm delighted to announce our speakers, two esteemed speakers that we have in front of you here. Mr. Pradeep Jaisingh, a seasoned biotech entrepreneur with a string of successful ventures, and Mr. Uday Chatterjee, a prominent biotech investor who has supported numerous groundbreaking projects with Indian Angel Network and BioAngel. Moving forward, I'll quickly jump on to the session without wasting any further time. Both the investors here in front of you are veterans in the space of healthcare, biotech overall. And with this, I'll introduce, I'll like to ask some questions around. This is in terms of Mr. Uday, you've been around, you've seen n number of companies, you supported them, and so has Mr. Pradeep Jaisingh. Both of you have been a veteran in the space. What is your immediate, reaction when you look at a deal, when they come to you for the pitch? in the first 10 minutes, what is those points that you would want to see in a company? And I don't want you to go into very detailed discussion, because there are a lot of questions that I have for you. So if you could just bring in just 3 points, both of you each, to start with, and then we go into further discussions around.
Sure. Sandro, in fact, I and Pradeep had got together yesterday, and we said that we are not going to repeat what is already known in these days, thanks to ChatGPT. So we don't want to talk about that. What we're going to talk about is what we have experienced. I must have personally heard about 1,000 pitches and, been involved in 100 investments, maybe more than that, and quite a few in the biotech sector. And you're right. The when you're listening to a pitch, I think you pretty much make up your mind in the first few minutes, whether it's looking good or it's not worth listening to it. And of course, if it is looking good, you go deep, what we call deep dive, and you do series of iterations of technology, what they're trying to sell, etc. But yes, when I'm listening to it, first thing I look is how novel is the idea, so how differentiated it is, because we tend to come into very crowded spaces. And once you come into very crowded spaces, it's very difficult to then navigate your proposition further. So one for me would be how differentiated you are, how valuable is your proposition, how much of a niche you are able to kind of visualize and work on that particular niche. And the second point that I would be looking at is the kind of team which is there to most of the time I've seen a lot of deals, it's run by one ambitious sort of promoter. But beyond a point, unless you have team with differentiated skills sets, it's difficult to go through. And third, of course, I mean, as investors, we have to look at what are the prospects, how quickly can it scale, and when it can be profitable. Because those notions of being profitable in 20 years time and burn for 15 of those years is now over. So now we have a new paradigm, and that paradigm has to clearly define where we are going to kind of reach that point of profitability.
Thanks, Mr. Pradeep.
Yes, thank you. And I think Uday put some very interesting point. Obviously, I mean, I think like Sandro, to your question, the first 10 minutes are critical. So as investors, we realize that this is only 10 minutes, but these are very important 10 minutes. So the first thing to look at is what are the first impressions. So first impressions can gauge the founder conviction. How strong is the founder's conviction about their own idea? Of course, they are very passionate about it because this is what they have chosen to do. But I think still how strong is their conviction that comes through in the first 10 minutes is very vital. As investors, this is a very tacit skill that we really develop. That because we have seen hundreds of pitches, thousands of pitches over the years, there are certain things about the founder's conviction, founder's body language, how the founder is presenting, or the team of founders is presenting their ideas. We can get a really good sense of that. And so that is number one. The second is in terms of how realistic they are presenting what their idea is. Till about a year and a half, 2 years ago, it was very common that a lot of people were getting carried away by this irrational exuberance, as you call it, about putting larger and larger TAM, putting how large their idea and the market that they are addressing can be. it's all because of the valuation they were targeting and trying to unduly impress the investors. But investors do it day in and day out, so they are able to see through that. That is getting tempered down. And then the third thing is, of course, you see, one of the factors that I really like to look at it, how long the founders, the 2 or 3 founders, whatever is the number may be, how long have they known one another? That is a very critical factor, because one amongst the most important factors where startups fail is also the interpersonal relationships and the chemistry amongst the founders. So that is something I always try to look at.
Thanks for that. That was short and nice. We talked about the first 10 minutes. In that, because we've seen so many pitches happen in front of us. What, according to you, is pitching? Is pitching an art or a science? Or it's good? I mean, I'll leave it up to you to answer on that. Probably one line should be good enough for that.
It's an art for me, because it's not something just so cut and dry, unless you have your emotions, into what you're pitching. Like Pradeep said, how deeply does the founder believe in what he's pitching, and over a period of time you can get that, you can read that. So I would say it's an art honed with a lot of hard work, a lot of sort of research, all of that. But at the end of the day, I will call it an art.
Oh, absolutely an art for sure. Sandro, clearly an art, but it's not an art. It's not drama. It's a storytelling. It's a storytelling based on inner conviction, based on data, based on the real situation. It's not a drama where you can make believe. So that is the difference. It is certainly an art. And how the founders are able to, at the end of the day, convey their own story. Because remember, in the first 2 to 3 years of a startup, the founder is also its chief business officer, its sole spokesperson. It's really the rainmaker. And so therefore, it is an art that requires very compelling and very conviction-based storytelling. That's why it's an art.
Great, nicely summed up. I think storytelling is actually a major play that actually works well. In fact, I'll just like to add one more thing there. What I've also seen is a lot of use case studies that they kind of share in terms of how the customers are actually getting really benefit of the product. It kind of makes it more easy for everyone to understand and kind of seamlessly go along with the founder in terms of while they present and showcase. While they present, we do come across. We've seen so many deals. One of the major problem that we see around is on the valuation piece that we see. People come up at an early stage. There is no signs of actually doing a DCF method or any other formulation where you say that this is what you do. You put in certain numbers here, and here is what your valuation looks like. It's all about assumption. It's all about how you calculate. So what's your take? How do early stage or pre-revenue stage companies, all the founders who are listening to us today here, what is your take? How does one come to a better valuation at an early stage, and what is right and what is wrong?
Would you like to take that, Pradeep, first?
Sure. I would say, Sandro, this is a very important question, and one that both the founders as well as the investors struggle with, because I think there is no science, and none of the well-established methods of valuation that they would teach you in the business school or what the academics have come up with, they are not pertinent. They really do not capture, and they cannot help coming to a realistic valuation of an early stage startup. So this has been an area of most dynamics, as you would say. So it's really, at the end of the day, it's a sort of a meeting of the minds, that is the sum total of it. But how do you arrive at the meeting of the mind is really three things. Number one is, what is the space? How differentiated, like early on, Uday mentioned how differentiated the space is. So the, where the barrier to entry is high, where the space is very differentiated, and the investors are keen to, make an investment in that area, they tend to attract a slightly higher valuation because of the attraction factor. And the case in point is right now, AI-based startups. So even in this deep funding winter, this is the constant feedback I'm getting even from the Silicon Valley investors, that a lot of AI-based, companies suddenly now are not only in great demand, but they are able to, get significant valuation. So that's number one. The second is, now, how experienced this team has been in their previous ventures or in their careers, and so how likely they are able to successfully execute on the idea that they have chosen in this particular market. And so that shows that how likely they are going to be successful, and therefore all things being equal, investors are more predisposed to accepting a more favorable valuation for a team that is more likely to succeed. And then the third thing is, are there any comparables? Now, this is a stretch of imagination, but are there any sort of comparables, like either from the previous funding rounds, other companies, either in similar space, may not be identical space, but maybe in similar space? Are there any comparables from related space, if there is nothing from the direct competitors, if the idea is sort of unique? And then you try to make that. And the fourth factor also is that even if the founders or the startup is desperate, the investors, especially the angels, and this is my conviction personally, the investors must not extract a larger share of equity for a smaller quantum of funding. Now, not all investors follow this, but I and Uday have talked about it earlier. I have also written about it. This is paramount. We must not, extract unfair equity stake, because it has to be, the angel round has to set the stage for the company's future rounds, and therefore it has to be very win-win. Those are sort of things.
Thanks.
So I just like to kind of add to what Pradeep said. So once I get into the stage of doing a deep dive, and during that period, I like to build a relationship with the founders. If I cannot build that relationship, I'm not very comfortable getting into a funding or mentoring situation. But happily, speaking about my personal experience, most of the companies, and quite a large number that I have been able to kind of work with, I have become not an adversary at that stage negotiating valuations, but I have considered myself a benevolent advisor to that company. And I, like Pradeep said, I never look to exploit them and get them to a rock bottom valuation, especially, funding winter. No, I advise them that for the first round, keep the valuation low and reasonable, but dilute less amount. Okay, so since we want to make it sort of, experiential, I can give you an example. Okay, so recently, and which you all are aware, recently we brought a cyber security company, and they're working at the kind of level where they can work for the Army, Navy, vital installations, etc. Cyber security, as you know, is one of the most vital sort of important subjects. And we had told them to dilute just 10% at a reasonable valuation. The founders were very comfortable. They would listen to what I said. And as it happened, and you attended some of those seminars which we did to promote that event with the Secretary Defense and many other people, our own Ajay Chaudhary coming on that seminar and so on. And against this theme of, investment winter, we had that deal oversubscribed within the first 1 minute. And then it got kind of oversubscribed at 25% and more. And then I got, one of the suggestions which came is that why not? Because many people were asking me that, you promoted it and now we can't get a part of this action. So I got one of the suggestions which came was that why not make it a larger round, double it. And I said, no, we would not double it because that will dilute the founders, interest at a lower valuation, which I have advised them. And I don't want them to dilute, 20% of their thing. And that's how we kept that lower. So I believe that, our relationship with founders should evolve in a way that we benevolently guide them to a good valuation. It should be low in the beginning so that in the next round they can get a much better valuation. Otherwise, if you go for a high valuation in the first round, when you want your sort of follow-on round or the next round, and you don't have a hell of a lot to show in that period, you are in a jam.
Yeah.
And down round is not a good word, and it's happening these days. So
Yes.
I would say to all the people who are joining this that do not be greedy and ask for a very high, sky high valuation, proves nothing. Raise the money that you need to accomplish certain goalposts. That should be the whole, idea of raising the first round, not what valuation. If you cannot move it to the next level, then that valuation will mean nothing in the future.
Fair enough. Yeah. Just continuing on this, Uday sir, I'll ask you directly on the question. So, what are the major reasons of failure for startups that have raised investment, and how do investors play a role in such a situation?
Sure. So, I mean, the 90% of the times companies fail because they run out of money. Okay. Now, this has to be planned well. So, once we have funded a company, or even while we are funding the company, we encourage these companies to be extremely frugal. The moment some startup comes with a fancy car, it raises red flags for me. So again, since I want to share actual life experiences, I was in Bombay for the Thai conference about a month ago, I think. And one of our very successful first level founders, Animesh from Chiliza, he came to pick me up, another person from our hotel, and he came in a taxi. And then we went to his factory and we went through the whole thing. He was extremely frugal. He didn't want to impress us, but I was impressed. I came back with this notion that this guy will go very far because he understands the value of each pie. He was not overspending extra rupee anywhere. Yes, for promotion and all those things he was putting, but not in the fridge. So that's one part, that I today look serially across all my companies that are founders frugal, to a fault. That's one. Two, I always tell the founders, like today also I was with one of our more later day companies, Sarijan, and we're talking about next day raises. So I always said that you have to start the next round of funding well in advance. when you see 6 months, you have runway, or that's not good enough. You have to start your effort 9 months in advance, and always have to keep a provision of extra 6 months. We take things for granted that money will come, but you have to add 6 months more to your runway. So these are fundamental things. We have to be frugal, not spend enough. So we have companies, other companies, small ticket companies with whom I've worked, and Sandro, probably some of them. They have not made huge progress in the last year and a half, but they're in good health just for the fact that they have not sort of wasted the money that they raised. Okay, I'm just briefly mentioning this. And now that they have learned over this last 18 months or so, or 24 months of their existence, now they're much more mature and can take this story much further. So I would say that till you're very sure about your product market fits and all of those things, be very, very strict with how you spend the money that you have raised.
Thanks for that. Pradeep sir, I have a different question for you. When you look at so many startups you've been leading, you've been supporting a lot of them. What are, say, 2 or 3 points which are totally non-negotiable or a total red flag for you, and you would probably walk away from a deal like that? This is for the entrepreneur friends or folks who are listening to us, so that they also understand what investors think while looking at it, and what are the major reasons of declining or passing a deal for some reason.
So, the very obvious first reason would always be that where you get a sense as an investor that the space or how the startup is approaching that particular opportunity is unlikely to work. And that is a judgment call. But I think your question is more towards the red flags that happen during the interaction. And that is really, again, back to the art part of deal making. And now this is from the investor side. So from our side, the things we look at, which are potential red flags, is where unrealistic founder expectation. That is number one red flag. When you see the person either doesn't display very sound judgment in terms of expectations or in terms of being aligned to the ground reality, that would be one red flag. Inflexibility or the rigidity, in attitude, that you can sense. As experienced investors, we can, absolutely get a sense. And then I yesterday briefly talked about it. So one of the key aspects for an early stage founder also is their coachability, how open they are to getting mentored. Mentoring is a word that everybody throws around these days, but mentoring is a two-way process. While really good mentors are very hard to come by, very hard to find, for a variety of reasons, but also the mentees have to be really open, and not only open, but very, having positive attitude and show the willingness to act on the suggestions of the mentors, because it's very critical. And I'll tell you what, connecting this with the previous question that you asked about startup failures, how critical this is, that inadequate capitalization is number one cause of startup failure. But we have an example here right now in India, flagrant example, where one of the largest companies that has raised absolutely incredible amount of money is right now in the midst of this crisis. And as you see every day, it is two factors. One is this very use of money in a manner which is contrary to the example that Uday gave. That's number one. Just like spending. So even if you raise tremendous amount of money, if you are spending so much of it and so fast, it ultimately runs out. That's number one. The second is, if you see 2 or 3 investor groups are specifically pointing out that they made specific suggestions during the course of meetings and interactions, and all of those suggestions have been ignored. And so it's not about the investor ego that their suggestions must always be taken or adhered to, but founder has to have a very strong reason not to really listen to, and it comes with its own set of consequences. So mentoring is a process which requires a very fine balance of this equation, where both the mentor and the mentee must really show openness, mutual respect, willingness to listen to each other, and then move forward. So that inflexibility or that rigidity in attitude is a big red flag.
Okay. Thanks for that. So, I'll just wear the entrepreneur hat right now. I've been an entrepreneur in the past, and we see all sorts of investors out there in the market, and same goes for entrepreneurs too. Now, as an entrepreneur, what set of investors should one look at? Especially for early stage companies, when they're going out in the market raising money, because they end up knocking every possible door. But then technically, that's also not right way to approach, right? What, according to you, would be the best way to approach investors at early stage, and what sort of investors should they approach in the first place?
So, Sandro,
Yeah.
I think before I come in on this question, I wanted to add something to your previous question,
Yes,
and as to what are the red flags. To me, one of the most important red flags when I'm looking at a deal is the absolute integrity of the founders. Okay, whatever you put in your deck has to stand. We can understand kind of over exuberance or things like that. But if you falsify your claims, then that's a no. So recently, again, I'm not going to name the company. We had a company in the biotech space. They came with huge sort of claims of how they had a platform with AI/ML that could do predictions across so many different sort of health conditions. And we had 4 senior, people, leads who were looking at it. And we don't always understand the exact science, because science is complex and so on. So I offered this company, as I have done in other cases. I get top companies, like I got in this case, Dr. Lal PathLab, and I organized that their chief scientific officer will have a chat with this guy and understand. And if whatever this company was claiming, if that was right, they had a possible entry or a likely collaboration even with a big company like Lal PathLab. And I organized a meeting for them. I organized the time, and I got back to this fellow twice, that this time has been fixed for you to go and have a chat, present yourself. I said that if you are, what you're claiming, if you can prove that, you may have a possible collaboration with them. And this guy never showed up. He avoided. And then, of course, they had I think a call which Sahaj from your team was involved, and they found out that this particular founder was making false claims. That's an absolute no. And if you do that, you'll not only lose the funding opportunity from one platform like ours, but you soon get a bad name and nobody will touch you. So I just wanted to answer that and then now over to Pradeep, I think.
Very about it. I think the credibility is such a vital factor that once you lose it, and even if, let's say, as network members, we are always acting with caution and responsibility, but still, once you lose the credibility here, it's just interconnected is very, that's clearly the biggest.
Yeah.
Thank you for sharing that.
We are willing to live with a lot of inadequacies, not having the entire picture or inefficiency. All of that is acceptable to a degree, because that's why we are called angels. We don't expect, from day one that there will be perfection. And in fact, if I may add, and this also all sort of smart startups must understand, that perfection is an enemy of progress. So don't always wait to achieve the ultimate before you come. You come and you evolve, and that also I and Pradeep discussed, that in the life of a journey of a startup, there will be many iterations, there will be many times when you need to change your roadmap. You have to kind of change your plan. You must have that flexibility to do it quickly. And again, to bring one example, our own Nokark is a shining example of that, celebrated. There is a book which has been written about it, and they were in the business of doing sort of robotics to clean solar panels. And during COVID, when that business kind of shut down because there was no activity happening and there was a crisis for medical equipment, within 90 days they created a ventilator from concept to a product which was medically accepted, etc. So
Yeah.
you have to be, as a promoter, you have to be extremely flexible and open to doing new things, trying new things.
Thanks for that. I think I'll take one last question before we get to the Q&A part. I think the Q&A, that we have a lot of questions there. So as an investor, you also look at exit opportunity. You look at what possibly could be your exit. So how important is exit
Sandro,
for you?
Sandro, do you want to cover briefly the previous question? We can just briefly respond to. That's a very important question, actually.
Yeah, I mean, if you can go ahead with that.
Yeah, let me just do that. Yeah. So I think because that's very important from the founder's perspective. How to really look for the right investor, and so that is a critical thing, because almost every investor or fund writes, "We are the smart money, we're the smart capital." That is just like a slogan. And the fact is, no, not every money is smart money. Not every, investor. And like I like to say, angels, for example, angels are not sharks, and they shouldn't be. So that is one philosophy. The other is the right investor is somebody who understands what are the key imperatives of this particular business. Maybe this particular business requires more patience. Like Sandro, the example that we just talked about 2 days ago. We are about to support a deal where we are very aware that this is going to require even higher patience than normally angel investors have to show. But consciously, we are going ahead with that because it is in the space that must be supported. So it's a mental health space for a specific community, and we have chosen to support it because as angel investors, we are not only looking for the deals where we can maximize our returns, but it is also, at least for many of us, it is also now a goal to support a wide spectrum of causes that resonate with us, that we are passionate about, that we would like to support, at least in terms of giving back as a as a investor community. And we have vocalized it, we have talked about it, and we are now trying to live it by an example. So finding investors who show that commitment, that understanding, that patience about you. Now, on the other hand, founders get so desperate. A lot of founders, when trying to raise money, and this is so relevant when we talk about the funding winter, because of the desperation, they're really trying to cast their net very wide. So like spray and pray. So send their deck to 100 people, whosoever responds. So they are really not exercising their judgment in terms of choosing the right investor. Yeah. The mistake that can come back to hurt you. So good deals, even in this funding winter, are getting funded. It's not like businesses shut down. As we were talking about, both in iron and outside, we are seeing good deals are getting funded. Good active investors are continuing the same quantum, maybe a little bit more caution, a little bit more diligence, but which is not a bad thing.
Thanks, Pradeep sir. Uday sir, would you want to add something on the exit side?
Yeah.
And yeah,
Sure. So, as a angel investor and investing in the sectors that I do, more of biotech, etc., I would consider myself a patient investor. So of course, if somebody comes and buys that company out, is good. But for that company to unravel its true value will need 5 years. And when I'm investing in it, I understand that. So I've met today, for example, a company at Venture Center whom I've known before, and they have just received what they call a fast track drug designation. That means a clinical trial in FDA that will take a certain number of years. Through that fast track route, you can shorten it by 2 years. And when you can do that in FDA, shorten the time period for drug discovery by 2 years, you'll save that worth hundreds of millions of dollars, for example. But still, it will take 5 years for that company to unravel and go through that all 9 yards of 3 phases of clinical trials. So I understand that. But I also understand that, for example, with one of our companies whose board meeting I've come to attend here, at the end of phase 1 of their clinical trial, their valuation in this winter has gone up 4x, okay, on the post money. And they have just closed the first phase. By the time they work on the second phase, which is starting now, already some European other companies are looking at their data. And if they find that convincing, they will make an offer to become a investor or take a sort of take a stake in that company so they can get the distribution rights, etc. So I've also invested in biotech companies, probably like Pradeep has outside India. So typically in the second half of the life cycle of the clinical trials, if they're doing well, a bigger fish, the large biotech, biopharma companies, etc., will come, put in a large sum of money, and which takes care of the third phase of the clinical trial. And they give them for that a lump sum of money, plus they take the distribution rights for that product across the world, etc. And you get a chance to exit. Okay, because when a large pharma company comes in, they don't want smaller players to be there. You get a good valuation, you come back. But when you invest, you must have that vision that it can take 5 years or little more for this company to achieve its true potential. So quite often at the end of 2.5 years, you do have a chance for exit. So yes, I mean, as an investor, you would not be doing sort of justice to yourself or to your profession if you are not looking at, exit. Exit has to happen, but you have to have patience, money, so that, at the end of, we see that also in our groups, at the end of 1 year, year and a half, people are getting, impatient. They're not making enough progress. So each company has their own life cycle, their own progress. Some of them will move faster. Some of them will move slower. Some of them have given us, we had a company which was going to give us an exit, in 9 months' time, and everybody was saying, this doesn't work for us because this will kind of, we'll be unnecessarily paying so much taxes, etc. We didn't know that it could happen. They didn't in this particular case. They had some problem with the due diligence with the next company. But that said, some exits will happen within 2.5 year time frame. But for a good company to give good sort of returns, I would keep 5-year term. And I was also sharing something with Pradeep yesterday that for investors like us to make really good return, we have to also support these founders through their follow-on rounds and the other rounds. So just that first one-time investor in the angel investment will not give you the best potential return.
Right. Thanks for that. I think we'll quickly jump into the Q&A part. We have last 10 minutes left in hand. So
Sure.
I'll quickly run through the questions. And if you've already answered, then I'll kind of get it done, move immediately to the main questions which are unanswered. The first one is from Nitya. It says, we would like to have an understanding on how to, this is on the valuation. I think we've already talked about this. How to pitch idea, how to attract investors on the idea in 1 minute of a pitch. One of you can answer. I don't want both of you to answer. We'll make it short and quick because there are about 16, 17 questions.
Pradeep, give the Stanford version. Pradeep also runs the Stanford Angels. So, he can give you, they're the best investors in the world. So, yeah.
So, I think how to, attract the investor in 1 minute, you always must remember there is no magic to this.
Absolutely. You have to work hard for it. There are no easy pickings.
So neither in sessions like this nor otherwise in life, please never look for, make-believe world or the magical things. There is nothing like that. Entrepreneurship is very hard. It's one of the hardest calling that a human being can imagine. And entrepreneurs are people who are willing to fail. They know that there is a significant chance of failure. They are willing to fail, but they are determined to succeed. And that is what makes them unique people. So in 1 minute, we make first impressions, but you are not going to attract any investor in first 1 minute, no matter how smartly dressed you come, how magically, you may present your slides, no matter what. Investors are, smart people. And also, because many of us have been doing it for such a long time, there is some value through this experience. And despite that, we keep making errors, keep making mistakes, both sometimes missing on great opportunities and sometimes getting into wrong ones. Both the errors we do, but still, this is despite the fact that we have developed a lot of skills, a lot of experience. So 1 minute is good enough for first impressions, but it is not the end of the story.
Okay. Uday, so the next one is for you. The question is around working in investing in companies which are working on the drug development space, especially in the cannabis-based drug development space. Is there interest? What's your take on it? Just one line, I think that 1 or 2 lines.
So, of late, last few years, cannabis, was sort of being used as a health, for health purposes. And in Europe, etc., there are already a lot of companies who are working in that space. And of late, in India also, we have seen a few companies working. In fact, even in my state of Uttarakhand, there are a couple of people working on cannabis space. It has a lot of good value proposition, also as a nutraceutical, etc. And we don't differentiate. If somebody comes with using cannabis, for that matter, silk protein, or for that matter, like, where Purvasha is working, I have interest in 2 companies right now that I'm looking who are doing extraction of proteins from leaves and vegetables. Okay, very promising. And so, we don't look at cannabis as some sin thing. We look at it scientifically as any other product that can be used for human good.
Got it. Thanks. The next one is on the valuation on protein. We already answered that. Do advisors add value to startup pitch, especially pre-seed? Well, I'll answer that. Some of them, they do clearly add a lot of value, but you need to understand if they really understand the space. that you're operating in. So don't end up signing up any advisor who doesn't understand your space at all. So I don't think so value will come that way. The other is while pitching, can you go and pitch alone if you don't have a co-founder? Yes, surely you can. That's not a problem at all. Is there any particular trend? So Pradeep, so you can take this. Are there any particular trend in the market that you currently find disruptive?
Yes, yes, of course. I mean, I think the one obvious one is AI, and we are very interested in, for example, I'm specifically interested, and I shared with you that we are going to jointly look at creating something on AI in healthcare, for example. I mean, I think very interesting area. The world has been talking about of AI in healthcare for last 10 years, but it hasn't happened. But I think everything has a time, and I think the time for this has come now because of all the other developments that have taken place. So that is one trend. The other trend is right now, I mean, in general, investing and startup trend is that the time being taken for funding is longer. The point of if it's your first round, you couldn't start sooner. If it's your follow-up round, you couldn't start sooner because bridge rounds or whatever. So that is a big trend. The other big trend is that investors are happier with the smaller checks. Even the larger funds are happy to participate in smaller deals. This is another trend that I'm seeing continuously right now. There's a lot of funds participating in earlier stage deals.
Okay.
And if I may add one more, because I had a meeting last night, and I think I also mentioned to Pradeep. So clean tech, is a very big need of our times. How do we produce energy which is clean? And so I am already invested recently, and I brought this company to Ion also to look at. It's a company, it's a company, there are others also, doing clean green hydrogen, okay, or clean oxygen, etc., which can avoid. So hydrogen is going to evolve as a major source of energy, replacing fossil fuels, etc. So any technologies which can on a large scale replace fossil fuels, that I think will be one of the new disruptive technologies for the future.
Yeah, we are looking at I'm personally invested in several on the climate change side, and I'm certainly looking at more. Definitely an area.
Yeah,
fair enough. We're actually running short on time, so I'll just handpick one or two more questions. That's it. This one is from Kapil. How to maintain same energy in co-founders or initial team member, and what are the red flags while choosing them?
The co-founder selection is one of the biggest and most important decision a founder can make. I mean, this really makes or breaks the startup, because it's almost like a marriage. And I'm not saying it in any sort of a superficial way, but it is true because the level of interaction, the intensity of interaction, and the complementarity that the co-founders need to display, it is so vital. And so therefore, spend as much time as you really need. Test them out, and the test of a co-founder, like test of a good friend, is always in difficult situations. Everything works well when things are going well. There is funding in place. You're getting action. But when things go wrong, that is when the co-founders need to stay strong, gel together, face the adversity together, come up with the pivot. I mean, it's almost guaranteed that the startup will pivot. They will have to go through second iteration, sometimes a third iteration. And so it tests the character of the people, and also it tests the resolve of a person. So resolve is a very, very strong factor in entrepreneurship. How resilient you are. And then you need to be resilient, not only just as solo founder, but how together as a team of co-founders, you can do that.
Right. Just one last question. I'll put this across, and one of you can answer this. The question is, not every investor understands deep science, deep tech science. So how do you make an investor understand your innovation in the most simplest way?
That's okay. So what I talk to, when I meet promoters who are in the deep tech space, and it applies to all such people, that you have to be able to put your proposition, the scientific proposition, in the simplest way possible. There are people with whom I deal with, and when they're speaking, I mean, even I cannot understand it. I have to go back and read and so on. But I hold that as a kind of drawback for that particular proposition. The proposition, even if it is a deep tech, the basic nuances of it have to be made stated in a simple way, because you don't expect a man who's come from a financial background or etc. to understand that deeply. But I have met many scientists, many and great scientists, who have been able to talk about their proposition, which me and probably people who are even less understanding of science than me could understand, the basic proposition.
Okay. Thanks, Uday sir. Thanks, Pradeep sir. Thank you for your time. This was quite insightful and quite a learning. Just to sum it up, folks, we talked about the art of pitching. The art of pitching is actually more of art and less of science. When investors look at you, they look for novel ideas, differentiator. The team should have the confidence. The team should be right. Founder conviction is important. Unrealistic founders are not accepted. Non-mentorable founders, again, are a total no-go for investors. Integrity of the founder, what they state in the presentation is very important. So stay put with that. Always remember, perfection is the enemy of progress, like Mr. Uday said. Also, one last thing, 90% of the companies fail because they're either not able to raise the next round of funding. So basically what it means is stay frugal and stay realistic that way. I think that will help them scale. Right. Thank you very much for participating and being around. I hope this was quite a knowledgeful session for everyone here.